Asian stocks have been slumping for a couple weeks, boo, and the chart has suggested the drop marks the end of a rally that started last March. Paul is our resident Grim Reaper on this Tuesday morning, and what are we talking about? Things go in waves, in this case, literally.
They do, which is why the rally we saw in the US, which may need to bounce today in Asia, shouldn't necessarily be taken at face value. We've had waves. Elliott Wave International is one of the most famous analysts on that wave, and they say after 3 wave patterns or 5 wave patterns in some cases in Asia, the rally is over. The polar opposite of last March's bottom. We're at a top. Take a look at the drop since a 52-week high for these main indexes. Shanghai down 15%, Hang Seng down 12%. So Chinese stocks whacked. That's dragged Australia down 9%, but also India, Singapore, Japan, and South Korea all down between 7 and 8% from their 52-week highs. Now, take a look at one analysis here. This it shows Fibonacci analysis, but it follows the same kind of pattern as Elliott Wave in this case. There was the top back in May 2008. There's the bottom in March 2009. And we've recovered about 2/3 of that slump here. And then we've had a fall off. We're now trading about 4% above what's called the 50% retracement. In other words, it's about 4% above a support level. So more declines may be to come. Take a look at the next chart. Any technical analysis you look at basically shows that we're in a downtrend right now. Here's the 200-day moving average. Again, the MSCI Asia Pacific Index about 4% above the 200-day moving average, so another 4% drop before we get any support. And here's the relative strength index. The best way to play the market so far this year has been to follow this. The RSI has been declining. Each peak has been lower than the last one. And once again, we're near this line down here, which suggests the declines may not be over. We may get support there, but if you break through it, more declines to come, and that's true for pretty much every market in Asia, Bernie. So could be a little bit more pain to come.
What's the RSI number on the right axis? On the
well, we're trading at 32.5, but it's not so important what the number is. 30 tends to be a support level of some kind, but when you break below 30, that just shows the declines are accelerating.
Or it could indicate severely oversold. Once you break well below 30, it could be a strong buy signal. When you take RSI classic interpretation in isolation without looking at the other ones you brought
If you break below 30, you're in oversold territory, but you can stay in oversold territory for a very long time, and you can go a very long way down. You look for the indicator to come back out of there before you buy.
I'll bet 1989 in the Nikkei went into oversold territory for the next.
It's probably been there a couple of decades.
21 years or something like that. Now, Paul was looking at a number of parameters there. Interesting stuff, saying that the Elliott Wave signals rally may be over, and then brought in a little bit of RSI evidence and a little more padding in the form of the Fibonacci retrace. But Wang Tao, president of the Singapore Technical Analyst Society, has been doing his own interpretation and says not so fast. Wang, morning to you. Now, I think you heard and saw what we were talking about there. You know, some of the chartists I talked to tend to take a different approach, and they say that basically a convergence with the 200 DMA is a litmus test and could represent a real swing opportunity back up. How do you read all the parameters which we just digested there?
Hi, morning, Bernie. First of all, for this technical analysis, it's a very subjective tool. Different people may have different interpretations. For this 200-day moving average, sometimes it provides support as well when the market just coming down or going up toward this level. So it's not definite to say that whether the market has turned bearish already. It only based on the 200-day moving average. So if let's say we talk about the wave pattern, it's more like the current drop is wave 4 instead of the topping wave 5.
So what are you saying? You're saying you see a violent upswing coming very, very soon? I mean, it sounds like your interpretation is a complete 180-degree opposite here. No?
Right. These few days is the rally yesterday from the U.S. market or the Asian market today. I'm expecting that the current drop from the top is going to finish very soon. Just waiting these few days and start the rally again. But this rally, whether it's going to be a fresh rally or it's a part of the correction, it's still under further observation. So I'm a little bit more bullish on the side instead of the very bearish, on the market.
Mr. Wang, Paul Gordon here. You'd have to be cautious, though, wouldn't you? When we get down to these support levels, maybe 4 or 5% below current levels, that's a test. You may want to buy at that point, but if it looks like stocks aren't going to hold, you're going to have to get out pretty quickly, aren't you?
You mean if let's say we are going to buy, it's going to be a short-term trading? It's not necessarily the case. Let's say the market is still sliding further 4 to 5%. I believe it's a golden chance to buy because the market has never been shown that the constant dropping or constant rallying. So after so much sharp drop, I expect the market to have a sharp rebound as well. So both for the short term and for the long term, it could be a good buying opportunity.
So how much would that sharp rebound be? 5, 10%, more?
If let's say the current drop is going to be 15%, we're likely to see the rally, the rebound to be around, I think, 8% to 9%.
Wang, we were talking, Paul and I were plying into, of course, the Elliott wave, paradigm, and we also brought in, of course, a little bit of Fibonacci application, and of course the RSI, the relative strength indicator, as well. Are you using other systems? I mean, does moving average, MACD, does a stochastic analysis yield any different kind of a prognosis for the market?
Currently, I've been using Elliott wave and the pattern as well. Remember last time when we did the technical analysis on the world stock market, the Dow Jones and also other major Asian equity indices shows inverted head and shoulder pattern, which has yet to be reached the target. And for the wave pattern, because a lot of people have a different interpretation of wave theory itself and the reading on the signal, so it could be very subjective. Some people are very bearish, some people are bullish. I'm also, I'm on the bullish side. Regarding the indicator, just now you guys mentioned that this RSI. RSI did show some bearish divergence. Paul mentioned that there is a lower low on the peak of the RSI. This is bearish in the bearish divergence. However, this could be temporary sometimes, as the trend may not be so changed fastly. Right. Just within a few days.